In the world of economics, there's one price that affects nearly everything else: the price of money. For more than 3 decades, this crucial factor was on a steady decline, but now it's heading in the opposite direction. In this video, we'll explore the factors behind this change and what it means for you, your investments, and the global economy. The basics of the price of money. To understand the price of money, think of it as a balance between supply and demand. Just like any other commodity, money's value is determined by these forces. Many might think that central banks solely control it, but there's more to it. The natural rate of interest. Economics enthusiasts refer to the price of money that balances saving and investment while keeping inflation stable as the natural rate of interest. It's crucial for policymakers to get this rate right, as setting it too low can lead to overheating and inflation, while setting it too high can result in unemployment. Factors that lowered the natural rate. For over 3 decades, interest rates in the U.S. were on the decline. Several factors contributed to this trend: strong economic growth, shifting demographics, China's growing economy, income inequality, and advancements in technology were some of the driving forces behind this drop. The consequences of lowering the natural rate. The decline in interest rates had profound consequences for the U.S. economy. It allowed households to take on larger mortgages, played a role in the subprime mortgage crisis, and made servicing the increasing federal debt relatively inexpensive. However, it also limited the Federal Reserve's ability to cut rates during recessions. A changing landscape. Today, several factors are reversing the trend. Demographics are shifting as the baby boom generation leaves the workforce, reducing the supply of savings. Geopolitical tensions and China's economic rebalancing have put an end to Chinese savings flowing into U.S. treasuries. The increasing government debt is also creating upward pressure on borrowing costs. Predicting the future. Based on their model, experts predict a rise in the natural rate by about a percentage point, settling at around 2.7% by 2050. In nominal terms, this could translate to 10-year Treasury yields reaching 4.5% to 5%. Potential impacts. A rising natural rate will have significant consequences for the U.S. economy. It could lead to the end of soaring house prices, impact equity markets, and place additional financial burdens on the U.S. Department of the Treasury. Winners and losers. Higher rates mean winners and losers. Savers with bank accounts can expect higher returns, while bond investors may enjoy better rates. Additionally, a higher natural rate gives the Federal Reserve more room to stimulate growth during recessions. After decades of falling interest rates, a changing economic landscape requires us to prepare for a reversal. This transition will affect everyone, from homeowners to investors to the U.S. Treasury. Understanding these shifts in the price of money is essential for making informed financial decisions in the years to come. Thank you so much for watching this video. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income. Don't forget to hit that subscribe button, like, and comment below and turn on your notifications so you never miss a video from Passive Income Journey 777.